Late 2025 has delivered a signal that most market participants will only recognize when it is far too late to act. If you look at the surface of the global financial markets, you might see the usual fluctuations in equities or the standard rhetoric from central bankers. But underneath that surface, in the plumbing of the global financial system, a warning flare has been fired. That flare is the silver market. To the uninitiated, silver is just a volatile metal, a smaller cousin to gold that often moves in erratic patterns. But to those who understand systemic risk, silver is the canary in the coal mine. It is thin, it is highly leveraged, and it sits exactly at the intersection of industrial necessity and monetary survival. Right now, the silver market is showing signs of a structural break. This is not about a simple drop or spike in price. This is about the failure of the market's internal promise. For decades, the global financial system has operated on a fundamental assumption that paper claims and physical reality are effectively the same thing. You buy a contract, you own the asset. But in late 2025, that bridge is buckling. We are seeing mysterious gaps in liquidity, sudden spikes in volatility during off-market hours, and a widening spread between what the screen says and what it costs to actually take delivery of the metal. When a market as essential as silver breaks, it means the plumbing is leaking. The reason this matters to every man watching this, especially those with significant exposure to the banking system, is that silver is often the first place where counterparty risk becomes visible. Banks and large institutions use silver and its related derivatives to hedge complex positions across the commodity and currency spectrum. When the silver market becomes dislocated, those hedges stop working. When hedges fail, margin calls begin. When margin calls begin, the quiet de-risking process starts behind closed doors. We are currently in that stage of silence. It is a silence that should be terrifying. In the halls of the major French banks like BNP Paribas or Societe Generale, risk managers are looking at the same data we are. They see the tightening of liquidity, they see the rising cost of funding, they see that the traditional models for measuring safety are no longer predicting reality. The breaking of the silver market is a technical signal that the era of effortless stability is over. The system is no longer absorbing stress, it is transmitting it. We are watching the beginning of a transition from a regime of managed confidence to one of forced recognition. This is not a drill, and it is not a conspiracy. It is the cold, hard mathematics of a leveraged system hitting its limits. As we move through this analysis, remember one thing. The mainstream media will tell you the story of the price, but we are here to track the structure. And the structure is telling us that the first support beams of the global financial architecture have just snapped. To understand why the silver market has reached a breaking point, we must look toward the east. China is no longer a passive participant in the global financial order. It has become the primary architect of its realignment. For decades, the Western financial system operated on the belief that commodities were neutral goods, governed by the invisible hand of the market and settled through Western clearinghouses. China has officially shattered that illusion. In late 2025, Beijing is treating silver, gold, and other critical materials not as tradable assets, but as strategic instruments of national survival and geopolitical leverage. China understands a fundamental truth that many Western investors have forgotten. Leverage is a vulnerability. The silver market in London and New York is built on a massive pyramid of paper claims. For every 1 ounce of physical silver in a vault, there are hundreds of ounces of paper promises circulating through futures contracts and exchange-traded funds. This system works perfectly as long as no one asks for the physical metal all at once. China has decided to start asking by encouraging domestic stockpiling and implementing subtle export controls. Beijing is effectively draining the physical float from the global system. This is a calculated move to expose the fragility of Western banking balance sheets. When China shifts its behavior, it does not issue a press release to warn the world. It moves through state-guided purchasing and industrial prioritization. As physical silver flows into Chinese vaults, the liquidity in Western markets thins out. This creates a situation where the paper price on the screen can no longer be defended by physical reality. When a major sovereign power begins to treat a commodity as a strategic asset, the assumption of always available supply vanishes. This changes the risk profile for every bank that has sold paper silver to its clients. The impact of this shift is profound. By breaking the silver market, China is testing the plumbing of the global dollar system. They are demonstrating that they can create a liquidity squeeze at will. For the French banks and other European institutions heavily involved in commodity financing, this is a nightmare scenario. They are caught on the wrong side of a structural trade. They have built their models on the assumption of deep, liquid markets and stable correlations. But China is introducing a non-linear variable that those models cannot account for. This is the new rule of the game. Physical control beats paper leverage. While Western banks were focused on maximizing quarterly yields through complex derivatives, China was focused on securing the atoms. Now that the atoms are becoming scarce, the paper promises are starting to wobble. This move by China is not just about silver. It is a signal to the world that the era of Western price discovery is ending. We are moving into a world where those who hold the material set the terms, and those who hold the paper are left to manage the collapse of their own assumptions. When we use the term broken market, we are not talking about a simple price crash or a period of high volatility. In professional financial circles, a market is considered broken when its internal mechanics fail to perform their primary function: price discovery and liquidity provision. In late 2025, this is exactly what we are witnessing in the silver sector. The anatomy of this failure is visible in three specific areas: the evaporation of depth, the dislocation of pricing, and the rise of counterparty distrust. To understand the gravity of the current global situation, one must look past the headlines and examine these structural fractures. The first sign of a broken market is the disappearance of liquidity depth. In a healthy system, a large buy or sell order can be absorbed with minimal impact on the price. Today, even modest trades are causing violent swings. This happens because the market makers, primarily the large bullion banks, are stepping back. They are no longer willing to provide the same level of liquidity because they can no longer accurately hedge their own risks. When the dealers go silent, the market loses its buffer. This creates a vacuum where a single medium-sized sell order can trigger a cascade of stop losses and margin calls, leading to a flash crash that has nothing to do with fundamental value and everything to do with a lack of buyers. The second anatomical feature of this break is price dislocation. We are seeing a historic gap between the spot price on the digital screens and the actual cost of acquiring physical silver in the real world. In a functional market, arbitrageurs would close this gap almost instantly. But today, the gap remains wide and is growing. This tells us that the arbitrage mechanism itself is broken. It means that market participants no longer trust that they can convert their paper claims into physical metal in a timely or cost-effective manner. When the digital price and the physical price diverge, the digital price becomes a fiction. It becomes a tool for settling paper bets, while the real economy begins to ignore it entirely. The third and most dangerous element is the rise of counterparty risk. Every derivative contract, every unallocated account, and every futures position is a promise. It is a promise that the person on the other side of the trade will perform their duty when the time comes. In a broken market, that trust evaporates. Institutions begin to look at each other with suspicion. They ask, if I demand delivery, can you fulfill it? If the price moves 50% in a week, do you have the collateral to survive? This is how a commodity problem turns into a banking problem. This structural breakdown in silver is a diagnostic tool for the entire global economy. It reveals that the layers of leverage built over the last several decades have become too heavy for the underlying foundation. When the smallest, thinnest part of the system breaks, it is only a matter of time before the pressure migrates to the larger, more complex parts. The silver market is currently showing us the blueprint of how the broader financial collapse will unfold. First, through the loss of liquidity, then through the failure of pricing, and finally through the total breakdown of trust between the institutions that hold the world's wealth. In the world of high finance, panic does not always look like people shouting on a trading floor or long lines at an automated teller machine. More often than not, the most dangerous form of panic is silent. It is a methodical, calculated retreat from risk. As we move through the final months of 2025, this is exactly what is happening inside the world's largest financial institutions. The banks are not issuing warnings to the public. They are quietly restructuring their balance sheets, shortening their lending terms, and pulling back from the markets they once dominated. This silent retreat is the clearest sign that the professional risk managers have lost confidence in the stability of the system. The mechanism of this retreat is technical and hidden from the average investor. It starts with the internal risk models, specifically the value at risk or VAR models. When volatility in a market like silver or sovereign debt spikes, these models automatically trigger a requirement for more capital. The banks are forced to either put up more collateral or reduce their exposure. Because the global economy is already starved of high-quality collateral, the banks are choosing to reduce exposure. They are closing positions, refusing to roll over short-term loans, and raising the bar for who gets access to their balance sheet. To the outside world, it looks like a slight slowdown in credit. To those inside the system, it is a synchronized withdrawal of liquidity. This retreat is particularly visible in the interbank lending market. Banks are the primary providers of liquidity to each other. When trust is high, money flows freely at low interest rates. But when a market as fundamental as silver begins to fracture, banks start to wonder what else is hiding on their competitors' books. They begin to charge higher rates for overnight lending or they stop lending altogether to certain counterparties. We are seeing a quiet rise in repo rates and a tightening of credit spreads that suggests a growing fear of contagion. The banks are effectively building a fortress around their remaining capital, and they are doing so at the expense of the broader economy. For the French banking giants, this retreat is an act of survival. Institutions like BNP Paribas and Societe Generale have massive footprints in global derivatives and commodity financing. As China tightens its grip on physical supply and as market liquidity evaporates, these banks are facing a double bind. They cannot exit their massive positions without crashing the market, but they cannot stay in them without facing catastrophic margin requirements. Their only option is to quietly reduce their discretionary lending to businesses and consumers in an attempt to preserve their liquidity buffers. This is how the global economy begins to starve. Liquidity is the oxygen of the financial system. When the banks retreat into silence, they are effectively cutting off the air supply to the rest of the world. They are not waiting for a central bank to tell them there is a crisis. They are acting on the reality they see every day on their trading desks. By the time the mainstream media reports that the banks are in trouble, the retreat will already be complete. The institutions will have secured their own safety, leaving the retail investor and the general public to deal with the vacuum left behind. The silence of the banks is the loudest warning we will ever receive. While the signals in the silver market are global, the most acute pressure point in late 2025 is the French banking system. France is currently home to some of the largest and most complex financial institutions in the world. Names like BNP Paribas, Crédit Agricole, and Societe Generale are not just French banks. They are global, systemically important financial institutions. Their balance sheets are measured in the trillions, and their tentacles reach into every corner of the global derivative and debt markets. However, this massive scale has become their greatest liability. France is now the epicenter of the European banking crisis, and the reason is a toxic combination of high leverage and an unhealthy obsession with sovereign debt. The core of the problem lies in the relationship between the French state and its banking sector. For years, French banks have been the primary buyers of French government bonds. Under European regulatory frameworks, these sovereign bonds are treated as risk-free assets. This means banks do not have to hold capital against them. This loophole encouraged French banks to load their balance sheets with hundreds of billions of euros in government debt to juice their returns. But as interest rates remain volatile and France's fiscal deficit grows, these risk-free assets are starting to look like ticking time bombs. When the value of government bonds drops, the capital buffers of the banks evaporate instantly. Furthermore, French banks are uniquely exposed to the commodity dislocations we discussed earlier. Paris has long been a hub for trade, finance, and commodity derivatives. As the bridge between paper claims and physical reality in markets like silver begins to snap, French institutions are finding themselves caught in a liquidity trap. They have provided the financing for global trade flows that are now being disrupted by China's strategic hoarding and the breakdown of market rules. The margin calls are not just coming from equity markets, they are coming from the very plumbing of global trade. We must also consider the political dimension. France is facing a period of intense social and political fragmentation. The government's ability to provide a credible backstop for its banks is being questioned by the markets. Unlike in 2008, the public's tolerance for massive bank bailouts is non-existent. If one of the major French banks faces a genuine liquidity run, the state may find itself unable to act without triggering a sovereign debt crisis of its own. This is the definition of a doom loop. The weakness of the banks threatens the state, and the weakness of the state further devalues the bonds held by the banks. The French banking system is currently a house of cards sitting in a wind tunnel. The silence from the Élysée Palace and the headquarters of the major banks should not be mistaken for stability. It is the silence of an institution that knows its margin for error has disappeared. If the French banking system cracks, the contagion will not stop at the border. Because of the interconnected nature of the Eurozone, a failure in Paris is a failure in Berlin, Rome, and Madrid. France is no longer just a member of the European project. It is currently the greatest threat to its continued existence. The crisis unfolding in France is the opening chapter of a much larger tragedy, the final failure of the European sovereign debt model. For more than 2 decades, the Eurozone has operated on a convenient but dangerous fiction. This fiction stated that a bond issued by a fiscally struggling nation was fundamentally the same as a bond issued by a stable one, as long as they were denominated in the same currency. This led to a massive accumulation of debt across the continent, with banks incentivized by regulation to treat these bonds as the ultimate collateral. In late 2025, that fiction has finally collided with reality. Europe is now caught in a sovereign debt trap from which there is no easy escape. The trap is built on the concept of zero risk weighting. Under European law, banks are not required to hold any capital reserves against their holdings of sovereign debt from member states. This encouraged banks to treat government bonds not as investments, but as a form of high-yield cash. As a result, the balance sheets of the major European banks are now inseparable from the creditworthiness of their respective governments. When investors begin to doubt the ability of a country like France or Italy to service its debts, the banks in those countries effectively become insolvent on a mark-to-market basis. The very assets that were supposed to guarantee safety have become the primary source of systemic fragility. This situation is exacerbated by the current state of the European Central Bank, or ECB. In previous crises, the ECB could simply print money to suppress bond yields and provide unlimited liquidity to the banks. But in the environment of late 2025, their hands are tied. Persistent inflation and a weakening euro mean that aggressive money printing now comes with a devastating cost: the destruction of the currency's purchasing power. The ECB is caught between two impossible choices. If they support the bond market, they fuel inflation and social unrest. If they fight inflation, they allow bond yields to rise, which triggers a wave of bank failures across the continent. We are already seeing the first signs of the bond market revolting. Yield spreads between German bonds and the rest of Europe are widening to levels not seen in years. This is not just a technical indicator. It is a vote of no confidence. It means that global capital is fleeing the periphery and even the core of Europe, seeking safety in jurisdictions with more transparency and less structural leverage. As capital exits, the cost of borrowing for European governments rises, further straining their budgets and making their debt even less attractive. It is a self-reinforcing cycle of decline. The European sovereign debt trap is the ultimate expression of the global economy being broken. It is a system where the rules of safety have been used to manufacture a catastrophe. For the man watching this, the message is clear. The institutions you have been told to trust are the most exposed to this trap. They are holding the bag of a political project that prioritized optics over mathematics. As the silver market signals a return to physical reality and the banks retreat into silence, the European bond market is the final wall that must hold. But looking at the numbers in late 2025, that wall is already showing deep, irreversible cracks. Understanding how a localized stress event in a niche market like silver transforms into a global, systemic collapse requires us to look at the hidden architecture of contagion. Contagion does not travel through the air. It travels through the balance sheets of the world's most interconnected banks. In the financial ecosystem of late 2025, everything is linked through three primary channels: the collateral chain, the derivative web, and the psychological feedback loop. When the silver market broke, it did not stay contained, because the institutions that trade silver are the same institutions that provide the lifeblood of the global credit system. The first channel is the collateral chain. In modern finance, most lending is not done with cash, but with assets used as collateral. High-quality collateral, like government bonds or precious metals, allows banks to borrow and lend at high leverage. However, when the price of an asset becomes volatile or its liquidity disappears, its value as collateral is slashed. This is known as a haircut. When silver started behaving unpredictably, lenders began demanding higher haircuts. This forced borrowers to either provide more collateral or sell other assets to raise cash. Because the system is so tightly wound, a sell order in one market to meet a margin call in silver quickly spreads to the equity and bond markets. This is how a spark in a small room sets the entire building on fire. The second channel is the derivative web. The global derivative market is estimated to be over $1 quadrillion in notional value. This is a staggering sum that represents a complex network of bets on interest rates, currencies, and commodities. French banks are notorious for their massive derivative books. Many of these contracts are interconnected in ways that even the bank's own algorithms struggle to map during a crisis. If a major counterparty fails to meet a margin call due to the dislocation in the commodity markets, it creates a hole in the balance sheet of every other bank connected to it. It is a digital version of falling dominoes, moving at the speed of light, far faster than any regulator can intervene. The third channel is the psychological feedback loop. Finance is ultimately a game of confidence. As long as everyone believes the system is stable, they act in ways that keep it stable. But once the mechanics of contagion begin to show, behavior shifts from expansion to survival. When an investor sees a major French bank quietly reducing its exposure or raising its lending standards, they do not wait for a press release. They move their capital. This movement further drains liquidity, which increases volatility, which triggers more margin calls, and the cycle accelerates. This is the stage we are entering now. The mechanics of contagion have been activated. It is no longer about the fundamentals of silver or the fiscal policy of France. It is about the math of the exit. In a system where everyone is using the same models and holding the same assets, the exits are far too small for everyone to leave at once. The silent retreat of the banks we discussed earlier is their attempt to get through the door before it slams shut. As the contagion spreads from commodities to banks to sovereign states, the global financial system is discovering that its greatest strength, its interconnectedness, has become its fatal flaw. The most dangerous phenomenon in modern macroeconomics is the doom loop. It is a self-reinforcing cycle where the weakness of one sector feeds into the failure of another, creating a downward spiral that becomes nearly impossible to stop once it gains momentum. In the context of late 2025, the global economy is staring directly into the heart of a triple doom loop involving sovereign debt, banking stability, and the evaporation of real-world liquidity. This is the stage where the theoretical risks we have discussed become an existential threat to the wealth of every individual within the system. The first stage of the loop begins with the devaluation of sovereign bonds. As we have seen in France and across Europe, when the market begins to doubt the fiscal health of a nation, bond prices fall and yields rise. Because banks are the largest holders of these bonds, their capital base is eroded in real time. For a bank like Societe Generale or BNP Paribas, a 10% drop in the value of their government bond portfolio can wipe out a significant portion of their common equity Tier 1 capital. This makes the bank appear fragile, causing its own stock price to collapse and its funding costs to skyrocket. The second stage of the loop is the contraction of credit. As a bank's balance sheet weakens, its first instinct is to stop lending. It pulls back from the repo markets, it denies new business loans, and it tightens the requirements for consumer credit. This contraction starves the real economy of the capital it needs to function. Businesses fail, unemployment rises, and tax revenues for the government begin to shrink. This brings us back to the sovereign. A government with less tax revenue and a struggling economy is even less likely to pay back its debts. This causes bond prices to fall even further, deepening the hole on the bank's balance sheet. Around and around it goes, with each turn of the cycle destroying more value than the last. The third and most modern stage of this loop involves the breakdown of the collateral system. In the past, central banks could stop a doom loop by printing money to buy the bonds. But today, the intervention of a central bank like the ECB is viewed as inflationary and destructive to the currency. Furthermore, the collateral being used to secure these trades, including paper, silver, and synthetic derivatives, is being rejected by the market. When the market stops accepting the system's own definition of safety, the central bank's tools lose their effectiveness. You cannot fix a solvency crisis with a liquidity band-aid when the very definition of solvency is being questioned. This doom loop is why the silence from official institutions is so deafening. They know that to acknowledge the loop is to accelerate it. If the French government admits its banks are undercapitalized, it triggers a run on the bonds. If the banks admit the bonds are risky, they admit they are insolvent. They are trapped in a dance of mutual destruction, hoping for a miracle that the mathematics of late 2025 simply do not allow. For the observer, the lesson is clear. When the doom loop activates, the time for nuance is over. The system has moved from a state of manageable friction to a state of structural collapse. The ultimate catalyst that prevents the global financial system from repairing itself in late 2025 is the total breakdown of international cooperation. In previous decades, a systemic crisis could be mitigated through the coordinated efforts of the Group of Seven, the International Monetary Fund, and synchronized central bank action. There was a shared belief that global stability was the primary goal. Today, that era of cooperation is dead. We have entered an era where geopolitical competition has superseded financial stability. Major powers are no longer interested in saving a system that they believe serves their rivals more than themselves. This shift is most visible in the aggressive divergence between the East and the West. As we analyzed earlier, China's actions in the silver and commodity markets are not merely economic. They are an expression of a new strategic reality. Beijing has realized that by withdrawing its support from the dollar-based financial architecture, it can expose the structural rot in Western institutions. For China, the instability of the French banking system or the collapse of the European bond market is not a disaster to be avoided, but an opportunity to accelerate the move toward a multipolar world. They are prioritizing strategic resilience over the maintenance of global market order. This geopolitical friction creates a fatal problem for European policymakers. In the past, Europe could rely on a stable global trade environment and the implicit backing of the United States to manage its internal crises. But the United States in late 2025 is increasingly inward-looking, dealing with its own fiscal challenges and focused on its containment strategy against China. There is no Marshall Plan coming for the French banks. There is no global consensus on how to handle a sovereign debt default in the heart of the Eurozone. Instead, every nation is adopting a beggar-thy-neighbor policy, trying to protect its own liquidity at the expense of its neighbors. Furthermore, the weaponization of finance has destroyed the most important ingredient for market stability: trust. When sanctions, export controls, and the freezing of foreign reserves become standard tools of statecraft, the neutral ground of global finance vanishes. Investors no longer ask where they can get the best return. They ask where their assets are least likely to be seized or devalued by political decree. This is why we are seeing a massive flight toward physical assets and non-aligned jurisdictions. The global economy is fragmenting into competing blocks, and the financial institutions built for a globalized world are finding themselves obsolete. The conflict between geopolitics and financial stability means that the old firewalls are gone. A crisis in Paris can no longer be contained because the international plumbing that used to distribute and absorb risk is now being used as a battlefield. We are watching the end of the global safety net. For the man watching this, the message is that you are on your own. The institutions that used to cooperate to keep the world running are now actively working to undermine one another. In this environment, stability is not a priority. It is a casualty of the new great power competition. As we stand at the final sunset of 2025, we are moving from a period of managed perception into a period of forced recognition. The signals we have analyzed, from the historic surge in silver prices past $64 per ounce to the record 3.4 trillion euro debt burden crushing France, are no longer just data points on a screen. They are the final warning signs of a system that has run out of time, run out of collateral, and run out of excuses. The transition we are witnessing is not a temporary dip in the business cycle. It is a fundamental reordering of the global financial architecture. When the silence of the banks finally breaks, it will not be with a whimper, but with a series of structural collapses that will redefine wealth for a generation. The reality for the French banking system is now undeniable. With public debt reaching 117% of GDP and 10-year bond yields climbing past the critical 3.5% threshold, the sovereign doom loop has closed. French banks, holding over 600 billion euros in government debt, are facing a recapitalization crisis that could reach 150 billion euros. The ECB, having ended its bond purchasing programs in early 2025, no longer stands as an unlimited backstop. In this environment, the phrase "too big to fail" has been replaced by the terrifying reality of "too big to save." The recognition of this insolvency is what will finally turn the quiet retreat of the banks into a public scramble for safety. On the global stage, the role of silver has been the ultimate truth teller. China's strategic decision to restrict exports and drain physical reserves has exposed the massive fraud of the paper derivative markets. By December 2025, the world has realized that you cannot eat, build, or defend a nation with paper promises. This shift toward physical reality is irreversible. As the global economy fragments into competing blocks, those who hold the atoms, the energy, the food, and the metals will dictate the terms of the new era. Those who hold only debt and digital claims will be forced to absorb the losses of the old system's collapse. For the serious investor, the man who has spent a lifetime building and protecting his legacy, the path forward requires a cold-blooded assessment of risk. The strategy of the last decade, blind trust in institutional stability and passive index investing, is now a liability. Protection in 2026 and beyond will be found in three areas: tangible assets, jurisdictional diversification, and personal liquidity. You must move before the crowd. You must recognize that the safety guaranteed by the state is conditional, and that the institutions you were told to trust are currently the most vulnerable nodes in the network. The era of effortless stability is over. We are entering a decade of friction, where wealth will be preserved not by following the mainstream narrative, but by understanding the underlying structure of power and math. The silver market flare, the French banking crisis, and the geopolitical realignment are all chapters in the same book: the end of the debt-based global order. Those who accept this reality today will have the chance to thrive in the new world. Those who wait for the evening news to confirm it will find that the exits have already been locked. The choice, as always, is yours.